Hello everyone. In our last lecture, we have studied about the introduction of partnership. That is, we have learned the Partnership Act and what are the methods of capital maintenance, as well as we have also seen the formats of various accounts such as trading account, profit and loss appropriation account, and balance sheet. Along with that, we have also seen the adjustments as well as hidden adjustments in the partnership final account. Today we are going to learn reconstitution of partnership, that is the types of reconstitution of the partnership, that is admission of partner, retirement of partner, death of partner, and the dissolution of the partnership. Reconstitution of partnership. Reconstitution of partnership consists of changes of the form of the partnership. There is a changes in agreement among the partner which leads to change in the relationship between the partners as well as the partnership firm. They are sharing the profit as well as losses in the firm. The changes in the partnership firm may take the following forms. There are different forms of reconstitution of the partnership. The first one is admission of partner. In admission, the new partner is admitted in the business. He brings capital and his share of goodwill. Old partners have to sacrifice their share of profit for the new partner, and the share of goodwill will be divided amongst all partners. Next is retirement of partner. If the partner is retiring from the partnership firm, his share of profit up to the date of retirement of and capital other reserves of the firm will be paid to him. Old partners will gain the profit and there will be changes in the profit sharing ratio again. Third one is death of partner. Partner is going out of business due to death. His legal hire will get the partner's share in the business. Share of profit of continuing partners will change and old partnership agreement comes to an end. Here, the death of partner or sometimes retirement of partner may cause the dissolution of the partnership firm also. Now we'll see the admission of partner in details. According to section 31 subsection 1 of the Partnership Act 1932, a person can be admitted as a new partner only with the consent of all existing partners unless otherwise agreed upon. So here old partners are agreed to take the new partner into the partnership firm. New partner will bring his share of goodwill and capital and enjoy the right to share the future profit. Here goodwill is the future expected profit which is brought by new partner and share to the old partner. Now what is the need of admission of partner? Generally the new partner is admitted in the firm to expand the capital base of the firm as well as use the skill of the person to improve the overall performance of the partnership firm. It means to expand the partnership firm, new partner is admitted, his capital is used for the business and his skill is also used for the overall performance of the partnership firm. As we have seen on a last slide that the new partner is bringing amount of goodwill. That goodwill means the high amount of profit expected in the future due to the past reputation of the firm. It means the goodwill is the past reputation of the partnership firm bring by the new partner. A new partner must compensate the old partner for their sacrifice of the share in future profits and the efforts made by them in the past to build up the reputation and the goodwill of the firm. It means new partner is bringing his amount of goodwill for the sacrifice of the old partner, because old partners are sacrificing their profit in future. So it is the compensation provided by the new partner to the old partner. So the new partner is bringing the goodwill in cash. That is, if the new partner pays cash for goodwill to the old partners privately, no entries pass in the books of the firm. It means if the new partner is ready to pay the goodwill or the cash to the old partners privately, then there is a no entry in the books of account. In other cases, the treatment for goodwill in the books at the time of admission of the new partner, the circumstances of the premium method is followed. Now we will see the premium method of goodwill in details. Under the premium method, there may be the following different accounting situations. There is the first situation: goodwill is brought in a cash and the cash is retained into the business. Second situation is only part of goodwill is brought in cash and the cash is retained into the business. Another situation is goodwill brought in cash withdrawn by the old partners. And the last situation, that is the goodwill account already existing at the time of admission in the is written off by the partnership firm. Now further, the goodwill may be brought in cash, retained or withdrawn either fully or partly. Now these situations we will see in details into the next slide. Now we will see the accounting treatment of each situation. The first situation is goodwill is brought in cash and the cash is retained into the business. The first transaction is when the partner brings his share of goodwill in cash, the journal entry will be cash account debit to goodwill account, and when the goodwill is transferred to the old partners, the entry will be goodwill account debit to sacrificing partners capital or current account in their sacrifice ratio. Second situation, that is only part goodwill brought in cash and retained into the business. The first entry will remain same, that is the when the partner brings his share of goodwill, that is cash account debit to goodwill account, and the second entry, that is when the goodwill is transferred to all partners, the entry will be goodwill account debit, new partners capital or current account debit to sacrificing partners capital or current account. The third situation is goodwill withdrawn by old partners. That is when the new partner is bringing his share of goodwill and it is withdrawn by old partners. The first entry will remain same, that is cash account debit to goodwill account. Second entry, that is the goodwill is transferred to the old partners capital account, that is goodwill account debit, new partners capital or current account debit to sacrificing partners capital or current account, and then goodwill will be withdrawn by the partners, then the entry will be sacrificing partners' capital or current account debit to cash account. The fourth and the last situation, goodwill written off from business. The goodwill written off, the entry will be old partners' capital or current account debit to goodwill account. Hence, the goodwill will not appear into the books of account. As we have studied, the new partner is admitted into the partnership firm. Therefore, we have to calculate the new ratio of the partners, that is the new profit sharing ratio. And for old partners, we have to calculate the sacrifice ratio. We will first see new ratio. As the new partner is admitted in the partnership firm, the profit sharing ratio of existing partners changes and there is a need to calculate the new profit sharing ratio, including new partner. This ratio is used for writing of goodwill and capital adjustments. The formula for calculating the new ratio, if total profit is 1, we will find out the balance of 1, that is 1 minus share of new partner, and then we'll calculate the new ratio. That new ratio is equal to old ratio into balance of 1. Or if sacrifice ratio of old partners is given along with the old ratio, the new ratio can be calculated. New ratio is equal to old ratio minus sacrifice ratio. Now there are two formulas. It is depend on the situation whether the sacrifice ratio is given or not. If the sacrifice ratio is given, we will use second formula, and if the sacrifice ratio is not given, we'll use first formula. The another ratio is sacrifice ratio. When new partner is admitted, old partners have to sacrifice their share of profit to give the share of profit to the new partner. The ratio in which the old partners sacrifice their share of profit is called as sacrifice ratio. This ratio is used to retain the goodwill in premium method. Therefore, the formula for sacrifice ratio is equal to old ratio minus new ratio change in the profit sharing ratio due to admission of partner. Hence, we can simplify that sacrifice ratio is old ratio minus new ratio. Now we will see example of new ratio and sacrifice ratio. Here it is given an example. X and Y are partners sharing profits in the ratio 7 is to 3. X surrenders 1/7 of his share and Y surrenders 1/3 of his share in favor of Z. A new partner calculate new ratio and sacrificing ratio. Now we will solve this example. In question, they have given the surrender share of X and Y. The surrender share of X is 1/7 and surrender share of Y is 1/3. Therefore, the old ratio is also given between X and Y, that is 7 is to 3. So we first calculate the X sacrifice ratio, that is his surrender share into old ratio, that is 1 upon 7 into 7 upon 10. Here 7 will get cancelled and the sacrifice ratio of X is 1 upon 10. Same as Y sacrifice ratio is equal to one third of his share, surrender of share into old share, that is 1 upon 3 into 3 upon 10. Here 3 will get cancelled and will get the sacrifice ratio of Y is 1 upon 10. Therefore, the sacrificing ratio of X and Y is 1 is to 1. Now we'll calculate the Z's share. Z's share is equal to X share of sacrifice plus Y share of sacrifice, that is 1 upon 10 plus 1 upon 10 is equal to 2 upon 10. Now we have to calculate the new share of X and Y, that is X new share is equal to old ratio minus sacrifice ratio. Therefore 7 upon 10 minus 1 upon 10, here the denominator are same, that is 10. Therefore 7 minus 1, 6. The new share of X is 6 upon 10. Same as we'll calculate the Y's new share, that is old ratio minus sacrifice ratio. The old ratio of Y is 3 upon 10 and the sacrifice ratio is 1 upon 10. Here also the denominators are same. So 3 minus 1, 2. Therefore the new share of Y is 2 upon 10. Therefore the new ratio of X, Y and Z is 6 is to 2 is to 2, that is 3 is to 1 is to 1. The another reconstitution type of partnership final account is a retirement of partner. When one member ceases to be a partner and the remaining partners continue to carry the business of the firm, it is called as a retirement of a partner. It means here the partner is retiring from the firm. It is his voluntary decision, he is taking that decision and he is retiring from the firm. The new partnership business will continue with the remaining partners and the retiring partner will get the amount payable to him after considering net balance of the capital and current account, his share of profit or loss on a revaluation of asset and liabilities, his share of accumulated profit and goodwill, etc. So here the retiring partner will get the certain amount after a retirement by considering their capital balance, his share of profit and his share on a revaluation of asset as well as liability. Partner may retire from the business due to old age, misunderstanding among the partners, loss in business, or want to start a new business venture, etc. A partner may retire by giving notice to remaining partners in the case of partnership at will. It means the partner is retiring from the partnership firm at his will. He has to give the notice to the remaining partner for the retirement of his partnership in accordance with the agreement by the partner. If the agreement is over, then the partner may retire from the firm. And the last one, that is with the consent of all partners, that is the partner may give the consent to the retiring partner and then the retiring partner will get the retirement from the partnership final account. Likewise, in admission of partner, in a retirement of partner, we also have to calculate certain ratios, that is new ratio and gain ratio. The ratio in which the continuing partner decide to share the future profit or losses is known as new profit sharing ratio, whereas the ratio in which the continuing partner acquire the retiring partner's share is called gain ratio. It is normally used to write off goodwill created or raised to the extent of retiring partner's shares only. Therefore, the formula for gain ratio is new ratio minus old ratio. In retirement of partner, likewise, the treatment of goodwill is given. Goodwill raised to its full value. Only retiring partner's share in goodwill is raised. And last one, if only retiring partner's share of goodwill is adjusted without raising goodwill. Now we will see the accounting treatment of the various situations. The first situation, goodwill raised to its full value. The entry in the books of account will be goodwill account debit to all partners capital account. Here we have to note that if the goodwill already appear in the books of account, surplus value of goodwill is calculated, and the surplus value is calculated with the help of this formula, that is new value of goodwill minus recorded value of goodwill. And if we are written off the goodwill, then the entry will be continuing partners capital account debit to goodwill account. The another situation is given, only retiring partner's share in goodwill is raised. The entry in the books of account will be goodwill account debit to retiring partner's capital account. In this case, also we have to calculate the surplus value with the help of formula, that is new value minus recorded value of goodwill. And if the goodwill is written off, the entry will be same, that is continuing partners capital account debit to goodwill account. The last situation in retirement of partner is if only retiring partner's share of goodwill is adjusted without raising the goodwill. So the entry will be continuing partners capital account debit to retiring partners capital account. It means continuing partners is receiving the amount from the retiring partner, but if here we have to note that if the continuing partners pays cash privately, then no entry is passed in the books of account. The last constitution of the partnership final account is death of partner. A partner will cease to be a partner on his death, and hence death is considered as compulsory retirement. Hence, due to death, if the partner retires, it is known as compulsory retirement from the partnership. Partnership business may be continued by surviving partners if partnership firm makes provision in partnership deed. Means in partnership deed, if the provision is made after the death of any partner, the business will continue, then the partnership firm will continue its business. Partners makes arrangement to settlement account of deceased partner with his legal representative, who will be entitled at their choice to interest at 6% per annum on amount due from the date of death to the to date of payment. Hence, here The remaining partner will provide the amount to the deceased partner's legal representative and charge the 6% interest on amount due. When a partner dies, the following accounting adjustments are made in the books of account. That is, change in profit sharing ratio. That is, new ratio will be calculated if the business is continuing by remaining partner. The undistributed profits, reserve or losses are divided among all partners. Goodwill may be valued and adjusted. The assets and liabilities are revalued. The deceased partner share in the profit till death is calculated and credited to his account, and the total amount due to deceased partner is paid to their legal heirs or successor or their executors. So students, in today's lecture, we have learned about the reconstitution of the partnership final account. We have studied about the admission of partner, retirement of partner, and death of partner. The remaining accounting treatment, that is preparation of final account, we'll see in next lecture. Thank you very much.